Morning, everyone, and thank you very much for joining. This is the morning market review. It's Tuesday, it's the 29th of November. My name is Russell Shaw, I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Just going to bring up the high risk investment warning. I'll keep this on screen for a few moments, and I'll be looking between screens, so apologies if I'm not looking directly at you. Hey, Zanetta, Katie, Howard, nice to have you guys on the webinar. Thank you for joining. Just want to double check, can you guys see the disclaimer and you can hear me? Okay, good. All right, let's bring up the market commentaries disclaimer. I'll keep this on screen for a few moments. Okay, and our references MarketScope, TradingView, Bloomberg, and Forex Factory. Let's just have a quick look at Forex Factory. Canadian GDP out, 3:30 p.m. ZA, that's 1:30 p.m. UK. Governor Bailey speaking later, and then we'll get the conference board consumer confidence. The big news really is Thursday is core PCE, that's the Fed's preferred inflation measure. And Friday, we're going to have non-farm payroll. I have set up the room to live trade. Let me just get the for that. I'm just going to pop this in the chat. Yeah, so if you want to participate, just click on that. It's in the chat now, and you're of course most welcome to attend. All right, let's go through the Bloomberg email. The first headline reads as follows. All right, so there's been a clampdown in China. Protests against China's stringent COVID regime failed to take place on Monday, and that's as authorities deployed heavy police presence in major cities to deter a repeat of the weekend's demonstrations. With evidence of a clampdown on the streets of Beijing, Shanghai, Nanjing, and elsewhere, crowds largely stayed away. Okay. And that was despite plans to gather that were disseminated on social media. BlockFi bankruptcy. Crypto lender BlockFi has filed for bankruptcy, the latest digital asset firm to collapse in the wake of the rapid downfall of the FTX exchange, has stoked worries that more corporate failures lie ahead. BlockFi will use the Chapter 11 process to focus on recovering all obligations owed to BlockFi by its counterparties, including FTX and associated corporate entities. The company said in a statement, FTX bailed out BlockFi in the summer. All right, I don't think this is the last corporate downfall in this space. So I guess keep your eyes on the crypto industry. Dollar decline. The greenback looked unstoppable earlier this year when investors were adding to bets on inflation and US rate hikes. Now they're turning against it in droves. Former bulls, including JP Morgan Asset Management and Morgan Stanley, say the era of dollar strength is ending as cooling prices spur markets to trim bets on further Federal Reserve tightening. I think that makes sense. I think by and large, I feel that within myself, there's a movement away from the dollar. I haven't abandoned it altogether, but yesterday I did trade Euro US dollar long. We'll take a look at that in a moment. That may spell buying opportunities for currencies of Europe, Japan, and emerging markets. So we did look at the euro in a fair amount of detail yesterday. Oil cap. European Union states debated whether to set a price cap as low as $62 a barrel on exports of Russian crude after several countries demanded a level that could put more pressure on Moscow. But the talks remained stuck, diplomats said. Poland and the Baltic nations said that the price level was still too high, according to the diplomats. Diplomats met Monday night to discuss the negotiations after they were suspended last week, but it is unclear how quickly they can find agreement. All right, European stocks are headed for a flat start, so we'll just take a look at that in more detail as the investors assess property stimulus in China and hawkish Fed commentary. Later, foreign ministers begin 2 days of meetings in Romania. Expected data include GDP from Sweden and Switzerland and Canada. According to our Forex Factory calendar. And I think with that all said, let's take a look at our real rate. All right, let's actually put the euro underneath this as well. How does the from Katie? How does the change in dollar strength affect the Nasdaq and the S&P 500? That's a very good question. All right. Let me ponder. Okay, I got an idea how we should answer that, Katie. And we can probably look at this screen as a start. So we've got the markup. We looked at this yesterday. Here is the distribution. And here is the potential markdown. Okay, so this is the real rate. Take a look here, Katie. We're going to add in the US dollar. All right, let's make this one logarithmic. Similar chart pattern here. Markup, distribution, markdown. Okay, similar. The real rate is not quite as intense in terms of the markdown, but it is moderating somewhat. And that moderation has fed into the US dollar. And the US dollar obviously has a high, what we call a duration, a high sensitivity to real rate movements, and it's pushed down. So for every percentage move in real rates, you can see what the duration measures the change in the dollar price. So bang, it's been pushed down. Let's add in the correlation coefficient here. Right, and we'll do the euro after this. But this, I think, is a good start. So the question that Katie asked, well, how does the decline in the dollar affect Nasdaq and S&P? So the idea here is we've got the real rate at the top. So normal asking, we've got the real rate at the top. We've got the FXCM US dollar in the middle. We've got the correlation coefficient of the two together. And take a look at the correlation coefficient here, Katie. It's a 90%. So it's pretty close to a perfect correlation, isn't it? So if it's a pretty close to a perfect correlation, well, you know what? Let's change the question. Let's say instead of the change in the US dollar, what does the change in the interest rate regime actually mean for Nasdaq and S&P? It's effectively asking the same question. We're just replacing the instrument because of that 90% correlation coefficient. There is a caveat here, and that caveat is, well, the correlation coefficient's got to hold. And it seems to me that there is an intrinsic relationship between interest rates and money, the price of money. So I think we're on safe footing here. So what we can do is we can just throw in the Nasdaq underneath this. Okay. And what you can do here, Katie, is you can draw a markdown. Let's just try and line it up a bit closer. Mark down, and then the interest rates mark up, right? Distribution in interest rates, accumulation in NASDAQ, right? Now there's a markdown in interest rates. Well, the question here is, do we get the mark up here in NASDAQ? Theoretically, I would suggest we probably do. Theoretically, we probably do. Let's just add in the correlation coefficient here. And the reason I say we probably do is because NASDAQ is a growth index. Growth companies, very sensitive to interest rates. Very sensitive because of the time value of money, right? And you can see that whilst the dollar had an almost perfect positive correlation, we've got an almost perfect inverse correlation here at minus 91%. Isn't that interesting? So the idea, the answer to the question I would posit is, well, it depends on what happens with interest rates, not really what happens with the dollar. So if we do see that the interest rates continue on that markdown phase, I think that feeds into the risk markets probably on the way up, and that's what we can start talking about, have the markets bottomed. We can throw in the S&P 500 here just to do a similar type of analysis. Sorry about that. Let's just pop this in. Well, take a look here, KD. Let's pop in the okay. It's a mirror image, isn't it? Now take a look. What's our correlation? It's at 92%, isn't it? 92%. So you can see that the key here is, yes, there is obviously a causation or a causality between dollar and the NASDAQ and the S&P, but I think the missing link there is the real rate. Does that help, KD? Just let me know, because I think that's a really good question. In fact, let's throw in the DAX here. I think looking at the DAX here would be instructive as well. All right, and so again, a little bit of a warning here is that I'm using the US real rates as a proxy for global interest rate movements. So just bear that in mind. Mark down. Okay. A much briefer accumulation. Much briefer accumulation. Here is an obvious markup. Take a look at, we're at 84%, still a very strong inverse correlation here. So again, the sort of cornerstone or the linchpin, whatever we want to call it, is this guy right here, the real rate. So we've got to continue watching this and see if we are being whipsawed or if there is in fact a change in interest rate regime here. Instead of a mark up, have we moved into this mark down phase? And if we've moved into this mark down phase, well, that sets up a whole new paradigm for us to consider when we're looking at the markets. All right, let me see if there's any other questions. Just pop that in. I want to take a look at the real rate to the euro now. Let's bring that up. All right, so we've got another strong correlation here. So we're on 86% negative to the negative, right? So let's draw in here's our mark up on the real rate. Guess what? Here's our mark down on the euro US dollar. Okay, it's like clockwork, right? Here's the accumulation versus the distribution, right? Here's the mark down. Here's the mark up. Okay, so you can see that there is a certain change up compared to the beginning of the fourth quarter. It's very interesting. The whole hypothesis as we moved into the fourth quarter was, hey, the fourth quarter is going to be interesting because we potentially setting up for a dead cat bounce. Well, we've got the bounce. Now the question is it a dead cat bounce? It looks as if that moderation in the median CPR has made a world of difference. The conversation has changed. In other words, we can legitimately start asking about bottoms here. Okay, let's take this to the next level. Again, we did look at the COPOC indicator briefly before. Let's bring it in here again. Okay, so let's start off with the NASDAQ. All right, so we go to the monthly, and let's throw in the COPOC here. So the COPOC indicator is generally, it tries to pick market bottoms. It comes in slightly late, about 2 or 3 months late, but that's its only application. It can't pick market tops. Let's throw in the exponential moving average. And we'll make this a 3-month exponential moving average, right? I'm going to set this up as the default, which I did before. Somebody reset it. Okay. So you can see that we're still waiting for it to turn up here. So we don't quite have the NASDAQ turning up just yet, KD. So there is still a bit of, I think there is certainly a rotation of capital. The question is, how aggressive do you want to be with that? The NASDAQ here still doesn't have a reverse reference candle here. We don't have that reference candle. We've got condition 1, we've got condition 2, we don't have condition 3, and it's the 29th. So I don't know if we're going to get condition 3 here. And we don't have the COPOC turning up just yet. Remember, we would be late. We would be late with the COPOC, but the delay makes for a surer analysis. Let's take a look at the SPX over here. Yeah, okay, so Gurdeep's got a really good point here. I'm going to bring in your point in a moment, Gurdeep. Let's just complete the COPOC, and then, so Gurdeep has effectively taken a devil's advocate type of view, which I think is very smart. Let's just take a look at SPX 500. Let me make this logarithmic. Okay, SPX 500 actually looking a little bit stronger than NASDAQ, because it does look as if we do have the reversal here. Okay, we've got condition 1, 2, and 3 on the S&P 500. That's very interesting. We don't have it turning up here just yet. Let's take a look at DAX. All right, and DAX got a very strong reversal candle here. Okay, so the condition 1, condition 2, and 3, and it's looking almost like a legitimate signal here, isn't it? And then the last one we'll take a look at, let's take a look at 2 more. Let's take a look at Euro, let's take a look at cable as well. Okay, so let's take a look at Euro. Indran also asking for the Dow. Yeah, definitely. Okay. Well, okay, so Euro's got a very strong reference candle here. Okay, the condition was actually given 2 months back. So it's taken 2 months to get condition 2 and 3. We're getting pretty close to a crossover here. We need to, on the first, we need to relook at this just to see if there's a crossover here. Let's take a look at cable, and then we're going to go through to the Dow. Okay, another strong reference candle here. So the dollar certainly is giving up its advantage. And the reason I think that it's giving up its advantage is because of the expectation of, why is this not, there we go. Because of the expectation of really an increasing rates, but at a decreasing, an increase in interest rates, but at a decreasing pace. So effectively what's happening here is that markets are starting to anticipate reaching the terminal rate and reversal. What Gurdeep has effectively asked is, but what happens if the Fed comes in more aggressive? What happens if the Fed, which is of course a possibility, and if it does come in more aggressive, so if they deliver a 75 basis points, then we're going to see all of this just disappear, and we're going to get that next week, I believe. Is it next week? Let's just double check. Nope, it's not the 7th. Let's just try the 14th, perhaps. Yes, okay, I beg your pardon. It's 2 weeks. In 2 weeks' time, we'll get the Fed. Okay. Let's take a look at US30 here. All right, so US30 also rolling over quite nicely here, Indran. And we've got the, let's just see here, the low 287.10. Okay, so here's, okay, so we've got the reference candle here. And just taking a look at the Dow Jones, take a look at this, guys. One. Can you see where I'm going with this? 2, 3. Okay. Impulse move 1, 2. Impulse move 1, 2. Corrective move 2, 3. And now, are we moving into the next 1, 2? Well, if we are, well, then we need a reference candle reversal. Well, we've got a reference candle reversal. Tomorrow is going to be the last day of November. At the moment, it looks like we're going to get the reference candle reversal. That doesn't guarantee it. But without it, we definitely wouldn't get the 1, 2 impulse, the next 1, 2 impulse. So very, very interesting, isn't it? All right, let's just take a look at some charts that are closer to the current timeline. All right, so I did trade this yesterday. The swing over here, and then it reversed. So it kind of hit the stop somewhere here. That was interesting. We are sort of borderline zone 1, zone 2. So the question is, why are we borderline? Why are we not entrenched in zone 1? Well, let me take you back to Gurdeep's comment. Well, what happens if the Fed is more aggressive? So maybe that's something that's we've seen a little bit of uncertainty coming in here. Let's just see GERDIP if it goes back into zone 1. One more just to take a look at here. The median CPR. Okay. Okay. I think this is a very important chart. So we are going to get the PCE on Thursday. And I would expect to see some moderation in that PCE. If we don't get that moderation in that PCE, GERDIP, then all of a sudden your scenario becomes, I think, a lot more probable. If there is moderation in that PCE, then maybe the market's thinking in terms of a more dovish Fed is actually closer to a point. So Thursday is a big deal. But the reason why I think we probably do get moderation is because we can take this out and we can relabel this. And I'm going to put apex question mark. So are we at the apex here? Okay, this is a big deal. Now let's put the 2-year yield underneath this. Okay, let's put it underneath. All right, now what we want to do is put a correlation coefficient between the median and the 2-year yield. Okay, so let's throw that in. Okay, and you can see by and large, so there's since 2015, let's take it, there have been a few periods, well, a couple of periods where they've gone inverse. Got to think about that, but by and large, we've got a fairly strong positive, and right now we're at close to 100%. We're at 97%. I mean, that's astounding. So if we've got this apex, okay, then we've probably got a pretty close to an apex in the 2-year yield. What's the big deal about that? Well, 2-year yield is a very good proxy for monetary policy. Okay, take a look at this. Let's put in USO2. Okay. Okay. And what we'll do here is let's put in the Fed funds rate. Let's overlay the Fed funds rate. Okay. We'll use a new price scale. That's fine. Okay. All right. So you can just see that it pretty much mirrors peak, 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 peak. You can see it's so if we get an apex in the median CPR, then we probably get an apex in the US 2-year, or then we probably get an apex in the Fed funds rate. Well, that means we've hit terminal rate. Now, as soon as that 2-year yield starts coming down, I think the portfolio managers are going to go shopping. Let's just throw in, let's throw in the S&P 500 underneath this. That's not what I wanted to do. Yeah, that's better. Let's make this logarithmic. That's interesting. That's interesting. These apexes tend to lead into drawdowns. Not so much here. All right, so I guess this is something that we need to just be mindful of. That's something I wasn't expecting, to be quite honest. We'll just have to keep an eye on it. What I do think is that we're getting pretty close to the apex. What I do feel is that we should get some sort of support there. Let's just take a look at this in terms of NASDAQ. Still odd. I need to give this some thought, and we'll need to revisit this tomorrow. So here's an apex and get some nice movement there. This is 2008. Okay, so there's okay. All right, I'm getting a sense, and this is 2000. All right, let me give this some thought. What I feel is happening here is there's a time series bias. Okay, but I just want to give this some more thought before we explore it further. In other words, the interest rate movements here led into massive recession, led into global financial crisis. I don't think we're at the same situation yet. So there's some sort of time series bias. Yeah. Let me give this some more thought. Gertie playing dead cat bounces galore. Can't argue with that, Gertie. Chris just saying, let's take a look at the Dow Jones. Yeah, let's add it in actually underneath. Let's make this logarithmic. Okay, so it's similar stuff, Chris. Similar stuff, but I think there's a time series bias here. So let me just think what's the best way for us to explore this. I don't want to start an analysis until I've given it a little bit more thought. I don't think that this and this and this are equal. Let me give that some thought. The market is hoping for a soft landing. So what you may be suggesting, and correct me if I'm wrong, we're hoping for a soft landing, but based on history, maybe that hard landing still somewhere in the near future, which is utterly scary. But let me give this some thought and this is very, very interesting, and we're going to have to tackle this. I think I'll think about it today. We'll tackle it tomorrow. Tomorrow we've got the crypto minute. But somehow I will enmesh it together with the crypto. Have I missed the link to the NFP? So I've just set it up this morning, Kobus. It's in the chat. Can you access it? I'll resend it now. I've resent it, so you should get it. If you don't have it, just send me an email and I'll send it through to you. The rate moves are linked to the hard soft landing. Yeah, with you, Rob. That's a very interesting perspective and actually quite a scary thought, because if we get that hard landing, well, you know, everybody's kind of thinking, well, we're heading into the bottom, and now we kind of taking a look at 2000, 2008, and now we can ask the question, are we really? My gut feel is that there's a time series bias here. So let me ponder that for the rest of the day. We shall chat about it tomorrow. Any other questions there? Chris, did you get that link? Just let me know. Okay, cool. All right, guys, let's wrap up here. Let's meet again back tomorrow and see if we can get to some sort of sensical or plausible probable outcome from here. All right, guys, have a good rest of the day and a good evening, and we shall chat tomorrow. Thanks very much. Cheers, guys.